Another twist in the tariff tale sends the dollar back down again. It wasn't just the greenback that suffered on Friday. Global stocks slipped too as investors digested an appeals court decision to keep President Trump's tariffs in effect for now. This ruling came just a day after markets rallied on a ruling to block most of them. Jeremy Stretch is Chief International Strategist at CIBC Capital Markets. Jeremy, this latest ruling has sent the dollar down again. What's your assessment of the currency market reaction to all the tariff noise?
Well, Ramzan, in effect, what we've seen over the course of the last 24, 48 hours is just additional layers of uncertainty. And that just underlines the broader policy narrative, which is very much the case that international investors are becoming increasingly uncertain regarding holding US assets. And so the generalized idea or appetite of a diversification away from the US dollar over time continues to hold. So whilst we did see that dollar recovery on the back of that initial repudiation or pushback against those reciprocal tariffs, it is still very much the case that investors are very mindful of maintaining those dollar-based assets over the short to medium run because of the policy uncertainty that has been unleashed by Trump's presidency.
Do you think the dollar's sort of title as the currency of choice has now taken too much of a battering?
I wouldn't say it's taken too much of a battering yet, but I think the shine has certainly gone off the crown of the dollar in terms of its preeminence, in terms of its reserve currency status. Now, of course, as a reserve currency, there are very few material alternatives. The euro obviously hoped to become that reserve currency when it was created back in the late 90s, but in a sense, it has been hobbled by particular problems, not least of which the Eurozone crisis of more than a decade ago. And of course, the Eurozone still isn't a deep capital market in the same way that the US is. But I think we are going to see investors not necessarily significantly selling US assets, but I think what I would call passive diversification, I think is going to be the name of the game moving forward. So as international investors accumulate more reserves, I think they will be progressively increasing the proportion or weightings in non-dollar assets. And I think that's going to be a legacy issue from the Trump presidency, which ultimately will cheapen up the dollar and gradually reduce its dominance in terms of the global financial architecture.
Now, on Thursday, the president met with Fed Chair Jerome Powell and basically told him he was wrong not to cut interest rates. What do you make of this sort of intervention?
Well, of course, he's merely telling Mr. Powell face to face what he's been telling the markets for several weeks and more months. Mr. Trump is always of the opinion that he is correct on most policy instances, and he's certainly maintaining that in terms of the monetary policy story. Of course, he is a real estate developer at heart, and of course, they like nothing more than zero or low interest rates. So in a sense, there is a battle of wills between the Fed and the White House, but it seems to be the case that Jay Powell is going to stay the course until the middle of next year and his tenure coming to an end. And ultimately, he referred his policy stance to the president, namely full employment and stable prices. And he will continue to operate policy against that backdrop. And I think that's going to be the challenge that the White House will continue to press. But I think Mr. Powell will try and hold the line and look at the policy dynamics purely on the basis of the data.
Now, we actually do get a key factor for the Fed policymakers later with the PCE measure of inflation. What kind of reading do you hope for that might encourage them to cut rates then?
Well, I think we have to remember that, of course, the Fed, unlike most other central banks, does have that dual mandate. And I think that actually could be particularly pertinent. So, yes, we're focusing on that core PCE, but I think we shouldn't lose sight of the fact that if you look at the continuing claims in the jobless claims series, that is running at a level that we haven't seen in 4 years. So I think the labour market is showing some signs of fragility, not outright weakness, but fragility, which I think actually could be constructive for the Fed easing dynamic. But in terms of core PCE, we would expect policy dynamics to be playing in the favour of lower rates in the latter half of this year, because core PCE is probably going to slow to the slowest pace in probably 4 years. So I think that eases some of the immediate price pressures. But I think the other factor to consider is we also get the final Michigan sentiment number today, including that 1 year ahead inflation expectations component. And that at the beginning of this month was running at a level that we haven't seen since 1981. So I think the Fed will be looking towards a moderation in terms of those near-term inflationary dynamics, because that's important for inflation expectations and that's influential on the consumer dynamic.
Now, this week, bond yields seem to have eased back. The 30-year Treasury is back below 5%. But do you get a sense that the bond investors aren't completely convinced that the economy is heading in the right direction?
I think there is and will continue to be significant levels of uncertainty. Now, of course, at the back end of last week, we saw that one big, beautiful bill finally get through the House. Now we're watching and waiting to see how it's going to be dealt with in the Senate. But I think there is still this residual problem or residual concern that there is going to be a significant increase in the level of long-term borrowing, and the fiscal deficit is only going in one direction. Now, of course, tariffs and tariff revenues are part of that. But I think we have seen just an easing in terms of those tensions, at least in the short term. But I would say that those tensions have far from gone away. And I think it may well be the case that international investors, coming back to that diversification narrative, are probably going to continue to stand aside somewhat from those longer end, long-term US Treasuries. And that inevitably would risk causing some upward pressure in terms of yield levels. And that, of course, is a problem for Scott Bessent, the Treasury Secretary, when he's trying to refinance more than $9 trillion of US Treasuries through the course of this year.
That was Jeremy Stretch from CIBC Capital Markets. And don't forget, you can watch more videos on Reuters.com.